So let's just jump right in. We are constantly surrounded by prices, right? Numbers telling us what things are worth. But have you ever really stopped and asked yourself, how do we actually decide on that value? Whether it's a company's stock or, say, a priceless piece of art. We're going to unpack the art and the science of figuring it all out. And it all starts right here, $450 million. Back in 2017, that was the price someone paid for a single painting. The painting was called the Salvator Mundi, and it was attributed to Leonardo da Vinci. That sale made it the most expensive work of art ever sold at auction. I mean, just think about that number for a second. It's almost impossible to imagine. But this record-breaking sale didn't just make headlines. It kicked off a massive mystery. Because the story of this painting's incredible value, well, it isn't really about the paint or the canvas itself. It's about a single, really nagging question. Yeah, what if it's not actually real? See, not long after that gavel came down, art experts and historians, they started raising some serious doubts. Some people argued that maybe Da Vinci only painted part of it. Others claimed it had been restored so heavily over the centuries that, the original genius was basically lost. And this is where it gets crazy. The difference in value is just staggering. If it's a genuine Da Vinci, you could argue that $450 million is a bargain. But if it's not, its value absolutely plummets, maybe to just a few $1,000,000. Now, here's the most important part. The physical object, the painting itself, it never changed. Not one bit. The only thing that changed was our perception of it. And that right there perfectly illustrates the central idea we're talking about today. Value isn't some fixed objective number just waiting out there for us to discover. It's an interpretation. It's a story that we tell ourselves, a story that's shaped by our biases, our beliefs, and what we think is going to happen in the future. Okay, so this brings us to the art part of valuation. And here we really need to bust a few common myths that seem to trip everyone up. Doesn't matter if you're looking at a painting or a public company. So, myth number 1, and this is the big one. The idea that a valuation is this pure, objective search for some kind of true value. We really want to believe it's a precise, unbiased science. But the reality? Every single valuation is biased. And you know what? That bias is often directly tied to who's paying for the valuation and what they're hoping it'll say. So the real questions we should be asking are, okay, how much bias is in here and which way is that bias pushing the final number? All right, myth number 2. The more complicated the model, the more accurate it must be. You know the feeling. You see a spreadsheet with hundreds of rows and inputs, and you just think, whoa, this has got to be incredibly precise. But you know what? In the real world, simplicity almost always wins. It turns out that an analyst's actual understanding of a model goes down as the number of inputs goes up. A simpler model, one where you truly understand the core assumptions driving it, is way more powerful than some complex black box you can't explain. Okay, but even if valuation is an art, it still relies on a set of tools. It has a scientific side, and to get that, we need to open up our financial toolkit. And it all begins with what is probably the single most important concept in all of finance. The time value of money? It sounds complicated, but it's super simple. $1 in your hand today is worth more than $1 you're promised tomorrow. Why? Because you can take that dollar today and invest it. You can put it to work to start earning you more money right now. This is where the magic of compounding comes in. Let's say you invest $100 today at 5% interest. In a year, you've got $105. Simple enough. But the next year, you earn interest not just on your original 100, but on the whole 105. And over time, that little difference creates this amazing exponential growth. So this leads us to the opposite question, doesn't it? If we know how our money can grow into the future, what is a promise of some money in the future actually worth to us right here, right now, in today's dollars? Well, that calculation is called present value. You might also hear it called discounting. And this idea is the absolute bedrock of what we call intrinsic valuation. We try to estimate all the cash an asset, like a whole company, is going to generate for the rest of its life, and then we discount all of that future money back to figure out its value today. So that's the concept, but how in the world do we take this idea and apply it to something as big and messy as an entire corporation? Well, it starts by understanding this really cool relationship. From an investor's point of view, they have what's called a required return. It's the bare minimum profit they need to make to justify the risk of giving a company their cash. Now, flip that around. From the company's perspective, that investor's required return becomes their cost of capital. See, they're just two sides of the very same coin. Now, companies get their money from two main places. They can sell ownership stakes, that's equity, or they can take out loans, that's debt. And each one has a different cost. So if we blend them together based on how much of each the company uses, we get something called the weighted average cost of capital, or WACC. The easiest way to think about WACC is like a company's hurdle rate. It's the minimum passing grade. So for this company, it's 9.6%. Any project they take on has to earn a return higher than 9.6% just to create any value at all for their investors. Now, while that whole intrinsic valuation method is really powerful, you can see it relies on a ton of assumptions about the far-off future. So what analysts often do is use another approach at the same time: relative valuation. It's basically a shortcut. Instead of trying to calculate value from scratch, you just compare your company to its direct competitors using a standardized metric, what they call a multiple. And here's a classic example, right? Comparing Home Depot and Lowe's. We're looking at their price to earnings, or PE ratio. Now, this number over on the far right, it's calculated by taking the stock price and dividing it by the company's earnings per share. What it's really telling you is how many dollars investors are willing to pay today for every $1 of that company's current profit. It's just a really quick way to see if a company might be priced higher or lower than its rivals. So after all that, after looking at the art and the science, we find ourselves back at that first question: what is anything really worth? Well, it turns out even a simple tool like the PE ratio has a bunch of hidden issues. For one, it kind of mashes together a company's actual business performance with its financing decisions. It doesn't really account for risk, and of course, it's completely useless for any company that doesn't have positive earnings to begin with. So, yeah, it's a handy tool, but it's definitely not the final, true answer. And that right there is the real key. It doesn't matter if you're building a super complex financial model or just doing a quick comparison. The goal isn't really to find one single perfect number. The goal is to gain insight. It's to understand the story behind the numbers, to figure out what truly drives value for a company or an entire industry. Because in the end, valuation isn't just about spreadsheets and calculators. It's a language for telling stories about the future. It's a blend of art and science, of perception and reality. So the next time you see a stock price flashing on a screen, ask yourself, are you just seeing a number, or are you seeing a story that's waiting for you to interpret it?